Advisory services offered through VestGen Advisors, LLC, an SEC-registered investment advisor. Securities offered through Private Client Services, LLC, member FINRA and SIPC. Private Client Services and VestGen Advisors, LLC are unaffiliated entities. Any information discussed does not constitute investment advice. VestGen Advisors and Private Client Services do not offer tax or legal advice.
People of Chicago, welcome to In the Know Radio with Craig Bolanos, co-founder and wealth advisor at VestGen Wealth Partners. You want help from someone that you can trust, someone who knows what it takes to get retired and stay retired. Today, Craig's going to teach you what you need to know. So get ready to learn something that could change your life. Get connected to the show by calling 833-964-PLAN or go to GetRetiredStayRetired.com. And now, here's Craig Bolanos.
Hey, good morning. Happy Sunday. I hope your Super Bowl square comes true. I got money on a couple of them. We'll see what happens. And on that same vein, yes, I'm going to come out and say it. I might not be interested in either of the two teams that are playing today, but if KC can three-peat, maybe we'll get lucky. They'll all retire and we'll get a change of scenery, a change of the guard, because I would like to see my Chicago Bears come on top. I'm excited, but this isn't a sports show. This is a show about helping you get retired and stay retired. It's about giving you sincere and actionable ideas that you can use to improve the lives of yourself and your loved ones financially. 833-964-PLAN, 833-964-PLAN. Connect with us. Get retired, stayretired.com. You know, I thought since we're off to a decent start, yes, if you didn't notice, the markets are off to a decent start, we would pause and reflect back at the journey of what got us here. What's in asset prices? What are the global macroeconomic events so that we could appreciate the headlines of the last 18, 19 days of the presidency, and then take a look at what I call all of the potential movement so that we can be making good decisions and winning in 2025. And isn't it funny that if you go back some 13 months, now I know that's tough for some of us to jump in our time machine and go back 13 months, but 13 months ago, people thought that we were going to have to literally leap over a chasm, that it was going to be doom and gloom in 2024. Wait, doom and gloom in 2024? Oh, yeah, lots of people were talking about it. And I think it's reminiscent of that plot line that you see in literature when the protagonist, right, the good guy, overestimates the gravity of a situation and responds with a series of unfortunate decisions. Perhaps the most classic example of that is Romeo and Juliet. Oh, but Romeo thinks Juliet's dead. She's not dead. She's sleeping from the potion, and then the rest is history. But when I say doom and gloom, think of what UBS said. Here's the quote from Business Insider. Recession will hit the United States in 2024, so get ready for massive interest rate cuts. Or JP Morgan, as we approach 2024, we expect both inflation data and economic demand to soften as the tailwinds for growth and risk markets are fading, blah, 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 building monetary headwinds, geopolitical risks, and expensive asset valuations. All right, well, listen, I got news. Last time I checked for 2024, I don't know about your portfolio. I know about ours. Those pictures didn't unfold. 2024 was not the year of a hard landing. 2024 was not the year that the dollar was debased. The dollar is still the world's reserve currency. 2024 was not an election that was so contested that it drove the election to the Supreme Court and burned down the country. No, none of those things happened. So fear is the mind killer. And if we're going to be talking about getting retired and staying retired, we cannot afford fear, because decisions that are made out of sentiment, decisions that are made out of feelings, they're not good for people. At one point in time, as I look back and reminisce over 2024, there were firms that were looking for the S&P 500 to close the year at 4,200, 4,500, 4,600. The markets closed over 6,000. What did everybody get so wrong? Well, what they got wrong is when there's unanimity, what I call complete groupthink, you miss the data. And what did we talk about on this show? What did we visit with our clients on at VestGen Wealth Partners? We focused on the service side of the economy, the job side of the economy, the jobless claims, GDP, capital expense, non-defense, retail consumption, earnings per share. And when you looked at all that, it pointed to a soft landing. It pointed to a soft landing. And that's so important because, again, if you're going to get retired and stay retired, you got to have perspective. And that perspective should be measured in not days, but that perspective should be measured in decades. Measured in decades. Because I think what's happening is longevity is about to be extended for people. I think some of our new appointments are going to cut the crap out of our food. I think this move in GLP-1s, semaglutide, it's not just about weight loss. We're learning about the cardiovascular benefits and other things in rapid fashion. So where do we go? So coming into 2025, I'm talking a little bit about setting ourselves up to win this year. That's why you listen to the show. You want action. 833-964-PLAN. Get retired, stayretired.com. But coming into 2025, I refer to it as pragmatic optimism. Yes, pragmatic optimism. S&P 500 earnings are going to be growing. We could be as high as $267. You stack on top of that the fact that you just got the jobs data on Friday. We've had 49 consecutive months of growth. That's the second longest win streak in history. The unemployment rate, we've averaged in this country 5.7%. What's the unemployment rate today? We bounce between 4 and 4.1. Think of how good that is. Between 4 and 4.1%, that is nothing short of fantastic. So when I look at those things, I'm reminded of something. U.S. exceptionalism. Let's not be apologetic for America. Let's look at America for what it is. America is exceptional. And because this is an economic and personal finance show, what makes U.S. exceptional? It's the American consumer. I mean, think about how innovative we are. Who invented the credit card? America. Who invented the shopping mall? Americans. Who invented the convenience of online business to consumer? Think Amazon, Walmart, deliveries to your door. America. Heck, we even invented the value meal. I got one the other day. I shop by picture. I got a number 4. Yeah, I mean, this is an American thing. And with the US dollar trading as high as it is, America took over Europe last year in travel. Who owns the river cruise markets? It's all American. I think that's going to continue to play out in 2025. 833-964-PLAN. That's 833-964-PLAN. Get retired, stayretired.com. We're talking now about looking forward because 2025 needs to be, again, about winning. That's not just winning for the country. That's winning for us as investors. And as we look ahead to 2025, I think of the strengths, the weaknesses, the opportunities, and the threats. And what are those strengths? Household balance sheets and productivity. I'm going to come back to productivity and artificial intelligence in a minute. Weaknesses, these higher interest rates, and housing. I'll explain how housing could be a potential weakness. What are the opportunity set? There's still an opportunity for rate reductions from the Fed in the second half of the year. There is a definite opportunity for tax cuts. There is a definite opportunity for loose regulations. What are the threats? That strong dollar I just mentioned could be a threat. The uncertainty of how our tariff negotiations work could be a threat, but so far, it looks good. So, I remind you of this. If you're worried, if you find yourself anxious, If you're uptight, that is sentiment. We can work our way through that by focusing on data. And when it comes to investments, if we make our investment decisions based on a systematic, repeatable process that's tested in the trenches, following what our STAC, Strategic, Tactical, and Asset Allocation Committee reviews on a daily basis, that leads to the probability of occurrence, and it can allow us not to make these knee-jerk reactions when markets get tough. And that doesn't mean someone should never de-risk, but it means we don't want to inadvertently de-risk on sentiment only to have our portfolios and our returns derailed, like far too many investors did, by not staying committed to the fundamentals last year. That's what we want to do. We want to help you get retired and stay retired. And you know what? That's what you want as well. And I encourage you to connect with us. Connect with me directly. Get retired, stayretired.com. And let us share with you how our 3 pillars of retirement income, capital matters, generating sufficient income to cover the spend, having a plan to grow the capital base to outpace inflation. Let us showcase for you how we do that behind the scenes with an integrated system, because we're a family office for everyone, where you can get your investment advice under the fiduciary standard. You can access your financial planning under the CFP standard of care. You can work on your taxes, your estate work, your retiree health care, all in one place. And when you do that under one roof, you get something that's more proactive because it's more comprehensive. Stay tuned, more to come. AM 560, The Answer.
It's more In the Know Radio with Craig Balanas on AM 560, The Answer, where his goal is to pummel you with financial know-how until you say uncle.
So I'm not trying to be inspirational, and I'm not trying to see the world through rose-colored glasses. I'm just trying to help people see the opportunity set that lays in front of us. And as we talk about those strengths, weaknesses, opportunities, and threats, it is not a time to rest on our laurels. It is not a time to be passive. It is going to be a combination of passive and active that wins the gold and silver medals in 2025. And those strengths are, again, the consumer. The strengths are the improving household balance sheets for those who already have home equity, those who already have portfolios. One of the cracks, though, is this. I mentioned housing. How can housing be a challenge? Well, the prices of housing are sky high. That's not what I'm talking about, because it's great for people who have equity. It's terrible for people who are trying to get into the housing market. But we need to get people to stop buying bunk beds and start buying bedrooms. Yeah, let me say that again. We got to have people stop buying bunk beds and start buying bedrooms. There's too many people who are sitting here growing their young families, and they're bunking up the kids like we did in the 1970s, and they're not going out and buying the new house to get additional bedrooms. And why does that matter? Because housing is critical for consumption. Housing is a part of U.S. exceptionalism. When people move, think of what a pain in the you-know-what moving is. But think of all the costs that are associated with moving. Think of all the professional fees. Think about all the easy stuff: flooring, carpet, paint, furniture, window treatment, technology, landscaping, you name it. That stuff creates momentum in our economy. And we need to get the home inventory up. We need to get the velocity of transaction moving to make this economic run more durable. But something that's a game changer is productivity. We're talking about the things that give us a good background going into 2025. And what I mean by productivity is AI, artificial intelligence, is the potential game changer. And higher productivity could boost wages, keep inflation with a lid, and that would allow the Fed to ease up on rates, possibly boosting business investment, which is what we all need. And that means, in our opinion, it's just our opinion, there's no rate cuts coming anytime soon. We got our rate cuts in September. We got them in November. We got them in December. The best news of all is the bond market that was inverted for how many years is now back to normal. But I want you to know that when we get to the second half of the year, if we have intelligent policy, good decisions, there might be room for one more rate cut, and boy, that's needed for housing. That being said, what's another weakness? The strengths are immeasurable. But a weakness? The $36 trillion albatross hanging around our neck? That's a problem. The fact that every single American citizen is responsible for 100 and some thousand of this debt, the fact that those who actually pay taxes, because not everyone pays taxes in America, are on the hook for 300,000 apiece. And I was watching the Talking Heads this week, and I almost threw my remote control through the wall because as I flip channels, because I want to be fair and balanced, you probably know what station I listen to all the time, but I was listening to another station and they were talking about we don't bring in enough revenue. And I'm like, oh my gosh, who said that? You know, revenue is tax receipts. And in America, corporations pay taxes. In America, I pay taxes, you pay taxes, and the amount of tax receipts we've collected have gone up by 60% in the last 10 years. So America collects 60% more money than it did 10 years ago. But somehow, we have spent 99% more in the same 10-year period. That's a problem. Because at some point in a future state, not today, there is going to be a day of reckoning. And either the spending's going to have to go down or the revenue is going to have to go way up. And guess what? I don't think politicians know how to cut. I think it takes private people coming in. That's what you're starting to see in the last 18 days now. But my fear is what we're all up against is TIR, taxes in retirement. And if we got time, we'll talk about how to diffuse those taxes in retirement, how to diffuse what could be a potential ticking time bomb, how to diffuse the potential crosshairs that you have sitting on your IRAs, your 401ks, et cetera, because you want to get in front of an event that could come years down the road. So what's on your to-do list for 2025? As we talk about investing and making strides, 833-964-PLAN, 833-964-PLAN. Get retired, stay retired.com. Equities are still good, but we're not going to be running at a cheetah's pace. But if this market's going to continue to broaden, I talked about this last week, in January, 10 of the 11 sectors all traded higher. Boy, that's good, but it means the S&P 400, mid-cap stocks, the S&P 600, small-cap stocks, they're going to have to come along for the ride. And something else happened at the end of last year. The bull market hit its 2-year anniversary. You might be like, why do I care if the bull market hit its 2-year anniversary? Because bull markets that successfully go 2 years tend to be more enduring. Oh, they tend to be more enduring. That's important. I'm going to talk about that in a bit. But remember, part of my theme here is U.S. exceptionalism. And part of that U.S. exceptionalism is us, the American consumer. But there's another part of U.S. exceptionalism right now, and it's this. Data. Data is the new gold. And that means data centers are what it's all about. So whomever controls the data centers, and by the way, those data centers, they consume an incredible amount of power. So whoever controls the data centers, whomever powers those data centers is going to be the people who can harness the productivity from those data centers. And that is going to give whomever that is an inside lane to economic expansion. And I got good news. When I look at data centers, I look at Germany, the UK, China, Canada, France, Australia, Netherlands, Russia, Japan, Mexico, to name a few. There's 10 countries. Add all 10 of those countries up, they got around 3,300 data centers. Look in the United States, we got more than 5,400. Yep, there you go. So the U.S. has far more data centers than the next 10 countries combined. Why does that matter? It matters because there's a new arms race out there. And the arms race is about data, and it's about data powered by generative AI. And I got to make sure we don't rest on our laurels because this was headline worthy. We talked about it in January. If you listen to this show, we talked about that Chinese chatbot DeepSeek that got released, and it destroyed $1 trillion of stock market wealth in a day in artificial intelligence stocks. $1 trillion in a day. Why? Because in America, companies have been investing hundreds of millions, if not billions, to build out large language learning models for generative AI. And here comes this Chinese chatbot named DeepSeek, who supposedly, air quotes if you could see me, supposedly built it for less than $6 million. Okay, here's the thing. I don't think they built it for less than $6 million. It's got loads of problems. Ask the Chinese chatbot DeepSeek about Tiananmen Square. It can't even give you a response. What does that tell you? You know who's controlling it. But the fact is, whenever you're investing in innovation that leads to disruption, technology is fragile because if a new player comes in and can get it done cheaper, it upends the apple cart. But here's the gig. I think we're going to get to a point over the next several years where large language models and generative AI is going to come down dramatically in price inside the ecosystem and the vertical. And you are going to see the benefits of productivity per unit of labor hour in everything courtesy of AI. The company who makes your washer dryer, the company who services your house. It's not just going to be a technology story. It is going to be an everything story. And you need to make sure that you're invested there. You really do. But you need to make sure you're invested there with a strong set of risk budgeting. See, risk tolerance, that's about how we feel. That's sentiment. Risk budget is a statistical measure of risk using probability to share with you how much risk you can take in your portfolio to still get retired and stay retired. See, the science and art of retirement income planning is exactly that. It's a science and an art. And you can't just use rules of thumbs. You need something that's bespoke, something that is curated for your specific needs. And that's what we want to help you do at VestGen Wealth Partners. Connect with me, Craig Bolanos, GetRetiredStayRetired.com, GetRetiredStayRetired.com, 833-964-PLAN. Let us help you determine how to properly assess not your risk tolerance, but your risk budget. And let us share with you, and we're going to talk later in the program about private investment strategies so you can further diversify away from public markets, because you need to start seeing the world through a new lens if you want to get better results. All right, stay tuned. We're going to pay some bills. AM 560, The Answer.
You want more in the know radio? You can't handle more in the know radio. Okay, yeah, you can. And it's on AM 560, The Answer. Welcome back. Here's more with Craig.
I got good news. I got to the store early today. I got the chips, so Taco Mountain's coming for everyone listening when we watch the Super Bowl later today. I hope your Super Bowl square comes true. Now, we spent some time this morning talking about the setup in the markets, talking about some of the conditions, and now I want to start turning that into some sincere and actionable ideas to get you motivated, to seek improvement, to not rest on your laurels, to do better. And that's why I think now, right here in February, it's time for a reflective pause. Yep, I said that, a reflective pause. And the reason I suggest people should take a reflective pause right here in February is 2023 were good returns in market. 2024 was good returns in markets. We do believe that 2025 will continue to see growth in equities, but I think investors are going to need to be more active. I think investors are going to be a little bit more nimble. And I think investors aren't just going to be in a position to hang on to the S&P 500, because when you've got 10 stocks, the top 10 stocks making up 35.7% of the entire index, it creates tremendous asymmetrical return to the upside. But it also comes with what could be at a future state, not today, asymmetrical downside risk. And that's why I think people need to start getting excited about broadening into these other areas like financials and energy and healthcare and industrials, because a pro-growth, pro-administration, deregulation, this and that helps those areas. Pile on top of the fact that productivity increases in those areas coming from places like artificial intelligence should lead to earnings per share. And when you can obtain and purchase some of the biggest and best integrated banks on this planet at 14 times earnings, when you got a stock market trading at 22 times earnings, boy, some of this stuff is just on sale. It is absolutely on sale. And I teased earlier, most investors do a good job of getting diversified. That's diversified between stocks and bonds. But I find that most investors don't do a good enough job understanding bonds, because I think most advisors don't understand bonds. And bonds aren't just for ballast. Bonds aren't just for preserving wealth. Bonds are also about tremendous optionality. And now that we're in a spot where bonds are acting like bonds again, and what I mean when bonds are acting like bonds again is the yield curve was inverted for years. That's where short-term bonds were yielding more than long-term bonds. Wow, that's like bizarro world. No, we're back to normal. A 10-year bond pays more interest than a 5-year bond, which pays more interest than a 2-year bond. And that's important for people to understand, because it means that as certain sectors of this market zig, other things are now going to zag. They're not correlated in the same way. But there's 16 areas of the bond market, 16 areas. And I don't think people should own all 16. That's why I don't think people should be invested, especially when it comes to fixed income, in things like the aggregate bond index. You should be doing barbell strategies where you pair your treasuries with high yield. You should be pairing corporates with asset backed. And you should be working different levers to generate yield in spread products to get you strong returns, not just for cash flow, but to outpace inflation. But another big theme, I've touched upon it 2 weeks in a row, I'm going to touch upon it again, is I think 2025, the year of a reflective pause, because markets should continue to rise, but they're not going to run at the pace they used to. So if that is what it means for public equities, it is time to look at the rise of private investment strategies or alternatives. And the reason we talk about alternatives is to diversify risk, potentially enhance returns. Some alternative investments definitively are driven for income, to supplement the income, especially the income of traditional portfolios. And some alternatives are designed truly for preservation of capital, for principal protection. And I think that means for all sorts of investors, because investors, we all come in different shapes and sizes. It's an opportunity to look just beyond public markets and look into private. And why is that so important? I think it's time, starting in 2025, to modernize strategic asset allocation. Yes, modernize strategic asset allocation. I think of how the world has changed. You know, the total stock market index used to be measured by something called the Wilshire 5000. Anybody remember that from the 70s, the 80s, the 90s, the 2000s, the Wilshire 5000, the total stock market index? Do you know how many companies are in the Wilshire now? It's not 5,000. It's a little more than 3,000. Yeah. There's less publicly traded companies today than there were in the 70s, 80s, 90s, and the first part of the 2000s. Why? Because a lot of companies have said, you know what? We don't want to be public anymore. We want to go private because we're tired of being managed in 90-day outlooks. We want to manage the growth of our business in 5-year mantras. And there's lots of companies who back in the day would do initial public offerings and are now saying, you know what? We don't need to do an IPO to be a publicly traded security. We can simply stay private and get liquidity from private equity companies. Yes. So I think if people really want to modernize their strategic asset allocation and they want to be tactical in 2025, it's the year that people start thinking about the adoption of private investment strategies to complement their well-diversified public portfolios of stocks and bonds to achieve potentially better risk-adjusted results, to generate higher amounts of income than can be done in traditional passive income investments, to get layers of principal protection, and to invest in companies that might not be trading at outrageous price to earnings multiples by partnering with private equity firms based on the type of investor that you might be. And if you want to learn more, you absolutely can. 833-964-PLAN. 833-964-PLAN. Connect with us online. GetRetiredStayRetired.com. I'm Craig Bolanos. I lead a team of professionals who are here to deliver a family office to everyone. A family office is where you can visit with your investment advisor under that fiduciary standard, develop your goals-based and cash flow-based models, your financial planning with someone who does that work under the CFP standard of care. You can work and discuss the integration of your retiree health care, your Medicare Advantage, your Medicare supplement policies, someone who can help you with your TIR, your taxes in retirement, and someone who can help you craft that great manuscript, which is that estate plan, because I know you've got people that you love and they love you back. And that means we have responsibility to do that level of estate work. So connect with us, GetRetiredStayRetired.com. When we come back, I'm going to share with you some strategies that you can be using in the private investment landscape.
Would you like a dose of knowledge? Good, because Craig is back and about to fill your retirement prescription. Back to In the Know Radio on AM 560. The Answer.
So we've talked a lot about investing today in today's show, and it's important because it's a results-driven business. But what I think matters here is in an ever-changing world where banks are no longer the only lender, and mutual funds and ETFs and normal citizens are no longer the only investor. We get into a world of private equity, private real estate, private infrastructure, private debt, etc. And there's ways for people to participate depending on whether you're a qualified purchaser, a qualified client, an accredited investor, or some other variety. And it's not for everybody, but for those who want to learn more and those who want to be empowered, and those who say, I want to control my outcome. I want to modernize the strategic asset allocation I've been using for years. We start on the income side. Let's do fixed income investing better. Let's start using the right barbell, the right bullet, the right laddering strategies, but let's not own all 16 flavors of the bond market. That is key. But let's complement that traditional publicly traded fixed income with the world of private credit, private debt, where you partner and work with some of the largest firms. And it's probably names you haven't heard of or names you have heard of. And you start making the loans in a globally diversified portfolio to businesses where more often than not, you're in a first lien position. And historically, if it continues, there's income in the 8 to 9% variety. I think private credit is a tremendous opportunity for those who want to learn more and potentially diversify their traditional fixed income. Part number 2, I don't know that people should be speculating on hotels and marinas and golf courses and this and that. But when I think of undeniable secular trends, I think of omni-channel, those retailers who have brick and mortar and have successfully paired it with the online experience for the quick delivery of goods and services to the end consumer, us. Or I think of true online business to consumer. Think Amazon. Here's what supports all of that: industrial warehousing. You've seen it. I've seen it. Concrete bunkers going up all over the place, 80 to 100 garage doors parked off all the major expressways across the United States to support intermodal, which is the truck, the distributions of goods and services just in time to us, the consumer, who are buying them digitally. And investing in industrial warehousing through private real estate, I think, is a great way for people who want to be invested in real estate. That's a passive income solution that's not traded on the public markets by not doing it in a publicly traded real estate investment trust. I think it's a different flavor. And if you want to learn more, you can. Next, we're talking about investment ideas, modernizing the strategic asset allocation. If data centers are the new gold, and then power to power those data centers is what it's all about, that is going to take infrastructure. That is going to take a lot of energy infrastructure. And whether that energy infrastructure is green meaning it needs to be built because it doesn't exist today, whether it's brown, meaning it's existing infrastructure that needs to be refabricated, recreated, reimproved, the bottom line is investing in global infrastructure, because data centers are not just going to be a U.S. story. Everybody wants them. Everyone's pursuing them. And look what President Trump proposed with Stargate. It is about data centers. It is about the power for those data centers. And that's why I think giving the nod and looking at whether or not someone should invest in private infrastructure specifically that works on power generation is a very interesting diversifier to today's publicly traded portfolios. Next piece I think about. Again, none of these are for everybody, but they're for somebody who wants to modernize their existing asset allocation, is the world of private equity. So maybe instead of just investing in publicly traded securities, maybe 2025 is the year to get educated about how you can partner in correct doses within your risk budget, which is developed from your retirement plan, to see how you can participate in the world of private equity. And we are a gateway for all of those conversations. My job, my parents were teachers. I come from a long line of teachers. I consider what I do to be financial education. but we're also great at a different form of IQ. It's not just intelligent quotient, it's implementation quotient. It's the ability to help you implement positive change so over time you can have positive price momentum in your solutions that you need to get retired and stay retired. 833-964-PLAN. 833-964-PLAN. Connect with us online. GetRetiredStayRetired.com. That's GetRetiredStayRetired.com. The world is changing. It is changing rapidly. The new administration, using a football analogy, this is a hurry up offense. This is full on run and shoot. And the pace of change is absolutely incredible. For some of us, it's reinvigorating, almost intoxicating. And how are you going to participate in that change? How do you invest so that you participate in American exceptionalism? How do you ensure that the strategies that your family are deploying have been strategies that are TNT, tested in the trenches? How do you make sure that your strategies aren't based on sentiment feeling, but your strategies are based on data-driven analytics leading to that repeatable process of experience by focusing exactly on that? Probabilities. Those are the things we do. Those are the things that we do well. And if you've longed for a family office experience, because you want to work not with an advisor, you want to work with a team of advisors coming together under one roof in the verticals of investing under a fiduciary standard, cash flow, and goals-based retirement planning under the financial planning standard of care. You want to be focused on your estate planning. You really want to be focusing on your tax optimization, your TIR, your taxes in retirement. You need to pair that with strong solutions for your retiree healthcare while you acknowledge and strategize about aging in place. That's long-term care. All of those are conversations that we bring to the table because we have all of those multidisciplinary professionals under one roof. And if you want to learn more, you can. Connect with me. GetRetiredStayRetired.com. GetRetiredStayRetired.com. We want to reinstill faith and confidence with everybody that lost trust in the traditional model of financial advice, which is a sales culture. We work in publicly traded securities. We work clearly in private markets. We will help those who want to find out how to properly use annuities. Notice I said properly use annuities to create income streams of payments to complement the rest of their portfolio. But it can't be shiny objects. No one should be attracted to shiny objects. I want you attracted to disciplined, repeatable processes that are planning rich, because that's what's going to lead to success. Because ultimately what matters is getting retired and staying retired. So check us out on the web. So here's what we're going to do. We're going to go ahead, hit a commercial break, and we'll come back with some closing thoughts and some other actionable ideas. AM 560.
Windy City. Get ready to be blown away with a hefty gust of financial know-how. You're listening to In the Know Radio with Craig Bolanos on AM 560. The Answer.
I really think individuals aren't going to be able to use a simple set it and forget it strategy starting at some point in time in 2025. There's been a torrid stretch because of the concentration in the top 10 names in the S&P 500 that have allowed people to think the only thing they need to own is the S&P 500. That's what we call recency bias. That can be a fatal flaw. Remember, there's been periods of time in this country not that long ago, 2000 to 2009, where the S&P 500 made no money. I'm not predicting that now. But what I'm saying is the days of consequently setting it and forgetting it approach, I think it's coming to an end because there's new considerations every morning when you walk in the door. There's a great normalization that's happening with rates and valuations where equities might just be driven solely by earnings growth. And that could lead to less equity index concentration. So the subset of opportunities are changing. I mentioned the announcement of DeepSeek China in January. That could disrupt the dominance of US AI and some of those stocks. You think about changes that could manifest depending on how these tariffs do or do not get implemented. I'm in favor of being treated fairly. I'm in favor of reestablishing good trade and getting our fair share. That's important, but I think it's time to demand higher returns for the risk premiums that are out there. And that's why I think people are going to need to not just have publicly traded securities. People are going to need to start diversifying into private strategies and multi-market capitalizations this year and focusing on other sectors of the market like energy, healthcare, industrials, financials. And if you want to learn more, I encourage you. We want to connect with those that are like-minded. There's a reason I'm on AM 560. There's a reason we probably watch some of the same news channels. Connect with like-minded citizens and let's create solutions that are reflective of you and yours. I exist for one reason. We want to help people get retired and stay retired. And that does not happen with products. It doesn't happen with sales. It happens with a deep commitment to planning. And it takes a dedicated team of multidisciplinary specialists in different areas: investing, financial planning, cash flow models, taxes, estate, retiree healthcare, continuity of care, all coming together under one roof. 833-964-PLAN, 833-964-PLAN. Get Retired, Stay Retired.com. That's Get Retired, Stay Retired.com.